First of all, we are a quite sizable company with close to $1.2 billion of annual revenue, and we have about 4,800 employees worldwide. You can say what summarizes Archer is our slogan: we are the well company. What we do is provide drilling services and well services to ensure we optimize production in line with our customers' well program. We have three distinct business segments: well services, platform operation, and land drilling. Firstly, our well services division is our most valuable business division today, with more than 40% of our EBITDA. In this division, we close to 900 employees. We offer tools, technology, and services that help improve well performance and eventually close the well permanently. Our well services division delivered an impressive 47% growth in EBITDA in 2023, of which approximately 40% was organic growth. The division has delivered an organic annualized average growth of approximately 26% in the period from 2017 to 2023. And we expect this growth in this division to continue into 2024. And also, when adjusting our revenue for reimbursable revenue, which is a pass-through revenue related to one of our contracts here in Norway, we are also pleased to see a continuous margin expansion, now around 20% EBITDA margin. This is largely reflecting increased volume, but also international presence. Platform operations is the second of our three key business segments, representing about 35% of our total EBITDA. Archer is managing a drilling operation on about 50% of the platforms in the North Sea. This is a stable brownfield business with long-term contracts and strong cash flow generation. This division has contributed about 40 million in annual cash contribution over the last 4 years, even during COVID-19. In addition to being a great standalone business, platform operations enables us to upsell our well services business. As you might understand, being present on about 50% of the platforms in the North Sea gives a significant competitive advantage. We also have 2 model rigs that are critical for multi-year PNA projects. One rig is being prepared for the Fulmar contract to commence offshore operation in 2025, while one is operating under a 3-year PNA program in the UK for TAQA. These 2 rigs have significant potential within the PNA market over the next decades. Our third and final business segment is land drilling, mainly in Argentina. Our operation in Argentina and the oil and gas industry in Vaca Muerta basin is often overshadowed by the development in the Argentine economy. However, the oil and gas production in this region continues to grow. Attractive oil and gas resources are in place in Vaca Muerta, where Archer is well placed with high-spec rigs. The drilling service market is expected to improve as new transportation infrastructure is coming in place. Land drilling delivered strong operational and financial results in 2023. The strong operational performance in land drilling has allowed us to reinvest local currency and build for the future. Firstly, we mobilized one additional rig in Q2, which increased activity in second half of 2023. Secondly, we upgraded and recertified a further rig in the Vaca Muerta area, which will start drilling now in Q1. Lastly, we acquired 3 drilling rigs from H&P in December 2023, which will drive EBITDA growth in 2024. We used an uncertain political and financial situation in Argentina to focus on service quality, capitalize on opportunities, and build for the future. In addition, we invested in a geothermal company in 2022. The geothermal drilling and district heating are very interesting renewable energy sources that has a lot of similarities to drilling for oil and gas. Regarding the market overall, are we oversupplied or do we have enough oil in the world, and how this balance out is a difficult question. There's a large community of professionals trying to assess demand and supply balance. I do not think that I have a qualified view on the oil market from day to day or month to month. However, Archer is very well positioned in the production and brownfield part of the oil and gas value chain. Our focus on brownfield intervention and drilling in combination with well PNA ensures limited downside and meaningful upside in a business, even if the oil price were to come down from current levels.
All right, let's move over. Let's get back again to the company, and could you also talk a bit about the strategy of your company and what makes you unique?
Yes, certainly. What is important for our strategy is our growth strategy. We believe there is a multi-year upcycle in the industry in general, but also for Archer in particular. As mentioned already, our business is mainly brownfield in existing fields. Our strategy is to deliver services and technologies that optimize our clients' production based on their well program. And then, when the operators decide to close down their fields, we have the organization and capabilities to safely abandon those wells. Archer has a market-leading position within platform operation and provide high-end well services to our customers in the North Sea. We see a high demand for PNA and decommissioning services going forward. And short to medium term, particularly in the North Sea, the strongest activity increase we'll see in the UK, where the operators will spend approximately $26 billion towards 2040. The global offshore PNA market is expected to grow more than 100% in the next 10 years. This market, which to a lesser degree is impacted by fluctuations in oil price, will underpin profitable growth for Archer for decades to come. Our focus on brownfield intervention drilling in combination with well PNA ensures limited downside and minimal upside. Furthermore, and importantly, the PNA of oil and gas wells is an essential activity to curb global emissions and protects the environment through safe and permanent closure of these wells. Our strategy to focus on production and late life differentiates us from the major service companies, which have bigger business focus on delivering services and equipment to new wells being drilled. Secondly, we have grown organically both by expanding our market share as well as entering new market internationally. First and foremost, within our well services division. To further enhance our competitive edge within well services, we have over the last couple of years done 5 accretive acquisitions to expand our reach and service offering. Going forward, we target to capitalize on our product portfolio and organization capabilities, focus on international expansion in selective regions. Thirdly, our land drilling division is a well-run operation and is now the largest drilling contractor in Argentina with a market share of just about 30%. We are by many regarded as the best drilling contractor in the country, and our rigs were preferred and mobilized first after COVID-19. And this is in competition with major drilling contractors like HMP, Nabors, and Ensign. We own 8 high-spec rigs, similar to the rigs in the US, with replacement cost of about $30 million each. The newly elected president in Argentina is committing to transition the economy and the framework for international companies operating Argentina. We currently believe it's a benefit for us and our Argentinian presence in the years ahead.
What's the contribution of these different business units in terms of cash flow?
Well, the good thing is all of our business lines provide positive cash flow. In 2023, EBITDA less CapEx was about $66 million. The main cash contributor is the platform operation, which have generated about $40 million of free cash flow each year for the last 4 years. The strong growth in our well services division has been fueled by our investment in technology, equipment, and working capital, but the cash flow remains positive. At this stage, with a larger business, we will harvest more cash flow also from this segment. Since 2015, we have taken out $66 million from Argentina, of which $4 million in 2023. The cash generation was limited from 2020 as we rebuilt the business, but we are generating positive cash flow and the operation is self-funded.
Great. Next question. Could you go into the considerable EBITDA improvement you have reported for 2023? What have been the drivers behind this?
Yeah, we are very pleased to have reported 36% growth in EBITDA, and it's really the well services division that stands out. We grew EBITDA in this division by 55%, which represents about 57% of the growth last year in EBITDA. But also land drilling, we saw a good growth of about $11 million of EBITDA. Platform drilling, more stable, but still grew by $5.6 million of EBITDA last year. So very strong growth in well services, good growth in land drilling, but also growth in platform operations.
Good. And it seems like when you highlight your financial numbers, you point out that you've had a 10% growth in EBITDA from Q1 2022. And what brought about this change? Because people who know Archer know that you also have been struggling for a while. So could you kind of help us to understand the bigger picture here?
Yeah, I think we first of all, we are very pleased with the growth, and it really shows that our strategy and focus is paying off. With the 10% growth in average over each quarter, which is quite achievement from our teams, I think. And if you look at the contribution, the biggest contribution has been from well services, where we have dedicated the growth strategy internationally, but also in services and also through acquisition. So that's been basically the main fuel of the growth. And as we said before, from 2017 to 2023, we grew organically by 26% annually. So this is kind of underpinning our growth. In addition, in land drilling in Argentina, we have seen positive momentum. We have mobilized more and more rigs as we have expanded the operation, and we are seeing that this growth is continuing, and we are also continued growth in land drilling activity also in 2024. So all areas are growing, but the biggest growth is within well services.
You seem quite confident that growth will go on in 2024. What will be the most important drivers here?
Again, our international expansion in well services is a main driver, where we follow our clients internationally and we are expanding the service portfolio. It's a huge market for us. We are still quite small internationally, but truly we can drive growth. We have valuable tools, services that the international oil market is asking for, and we are taking step by step to grow that. And I think an interesting anecdote or testimony is we have recently agreed a development project with Petrobras for method to abandon their vast subsea wells, in order to PNA all their subsea wells. We have a program with them this year, and we will hopefully go out at the end of this year to test that method. And if we are successful, we have a unique opportunity to capture a significant portion of this market. It's again, we focus on PNA. We are the leading in technology, both for subsea wells and platform wells. And just as I mentioned, I think Petrobras has currently, within the next 10 years, 300 platform wells and about 300 subsea wells they want to abandon. So it's not about how big the market is. The market is big. It's our ability to prove that we can deliver it. So basically, continue to grow in well services. Platform drilling, it's a more modest growth into 2024, which we have said before, and in the detailed guidance. But we also already have the backlog for the PNA projects in 2025. So we know that we have a good growth and backlog into 2025 to continue that growth there. And again, Vaca Muerta is already contracts for the growth in 2024, so that's helpful. We think that this is going to continue to play out. Rista recently illustrated a scenario where they could double the production before 2030 in Argentina. That will require a lot of new wells to be drilled, and we are well placed to do that. And but we will see. We don't need the market to double to have a very successful growth in Archer in Argentina. We just want. It's probably better for all of us to have a steady growth. And the new president policy is encouraging export of oil from Argentina.
Let's dive a bit more into these business segments, and let's start with the plug and abandonment. And if I understand you right, this isn't the segment where you expect the biggest growth, but when we look at the overall market here, it really looks very interesting. You're talking about a doubling of this market in this decade, and so by the looks of it, it should be very promising for you. Can you go a bit more into how much you can capture of this market? How many competitors are there here, and how do you stand here?
So this is like, this market is certainly growing. And if you go back 10 years ago, there was not so much activity, but in the last 5 years, the activity has really come up. And the biggest contributor here is actually in the UK market, where they have all these old fields and lots of platforms that has been standing out there, not being done much with for the last 5-10 years. Now they're getting really old, and it's becoming very economically and to PNA the wells, and it's getting more scrutiny also from the regulators in the UK. So it's a massive opportunity for us. And what makes us unique is that we offer drilling services and well services. So if you actually map all our competitors, we are the only company globally that offers a broad spectrum of drilling services and have a broad portfolio of PNA tools. So this is sort of what makes us very unique. Both when we compete head-to-head with well service companies, we are probably the leading, maybe together with Baker, on the tool set and the service around PNA. But when we add to our drilling services, and we add to that, we also provide these PNA rigs, and we talk about the model drilling rigs that we have 2 of, makes us, for the clients who want to outsource the biggest scope, we are very well placed to take them. So we don't have that much technology, competition in that space. And it's more that they have all the betters. They could decide to contract drilling separately, well services separately, and they can also choose to have many different tool providers for the downhole tools. But I think the trend, like we saw on Fulmar, and we have a lot of discussions with large oil companies now over this model, where we take a big responsibility, we provide a drilling rig and all the well services, and this is, for certain clients, very attractive if they can find a way to contract it and tender it while not only awarding it and negotiating with Archer. So I think there's a lot of volume for all of us, but I want to just put in context, how big can it be? We said the Fulmar project is $165 million. It represents, of the UK decommissioning market, it's probably represent 0.5% of the market. And still, this one project will add 8-10% EBITDA growth in 2025 on Archer level. So they are significant, these projects. So if we can get 1, 2, 3, 4 of those projects, we will significantly grow our EBITDA and our revenue. So for us, it's about finding the right contracts and the right clients that wants this model, and really form long-term partnerships with these customers. For example, Repsol in the UK, they have 6 platforms now that it's very well. One PNA rig that we are considering with them, and then it is how can we get that contract, and secure the backlog for the next 10 to 15 years for one of these rigs, including well services. So that's a big market. We are very focused on it. I'm sure some of the other companies will come after us and try to take focus on the market as well. But we are certainly taking technology steps, tool steps, portfolio steps, and we have probably the most wells PNA'd in the industry at this stage. So we are well placed.
I mean, it's nothing new that many of these oil fields are maturing in the North Sea, and shouldn't we have seen more? Shouldn't we have seen more activity here in this business field already? I mean, we are in 2024, and shouldn't we have seen more activity here already? Given that these fields, as you say, they have been standing there for several years, several of these fields, and nothing has been done. So why should it take off now in 24 when it's been kind of not that much up till now?
So it's a good question, Karsten. This has been why many people have kind of given up on the PNA historically, because it was said to be much earlier. But if you actually look at it, it actually means that what happened was that if you go to Norway, a lot of the platforms that was going to be PNA, Equinor invested and upgraded all these platforms and extended the life by 5, 10, 15 years. So they had to put, it was economically to do the upgrades, an extension of life activity. So that's why it didn't happen. In the UK, it's a different story. I think last year, UK Oil and Gas announced that they spent £1.8 billion on decom in the UK alone. So the market is there. They have I think it's about 200 platforms in the UK that needs to be decommissioned. And unlike Norway, for example, which have maintained all the platforms, in UK they have not really maintained a lot of these platforms. So there are a lot of challenges to decommission, actually, both the platforms themselves and to get to the wells. Get access to the wells is becoming more and more difficult. The more corrosion and integrity issues there on the platforms, the more costly it's going to be to decom. So I think in the UK they have found that time now. If you look at Equinor, the biggest liability in Norway, if you talk about this, is their big expense will be after 2040. But Archer is their partner now to PNA Statfjord A, which is the big first major platform in Norway that's going to be a PNA from Equinor. So we are going to do all the drilling services and all the well services for that project. So we are well placed, and you say again, you asked why no. It's same. Petrobras tried to sell off all their platform-based, shallow water platforms to smaller companies, but the new president, when Lula came in, he stopped all that sale. So now the PNA liability resides with Petrobras, and now they have to start thinking about how to do it. They thought they could sell off the liabilities to other companies for them to execute the work. So it's a mixed picture everywhere. US very slow, offshore very slow, but no. I don't know if you read in newspapers the last few months. Is basically Chevron has got 300 wells back from companies fields they sold in the past, and the same with BP. So this PNA train is going to be big, and it's going to grow in all markets in our estimation.
But if I understand you right, platform life extension, that could be a threat to this business segment. That would mean that decommissioning is put off and platforms go on living for a while.
Yeah, but I think you have reached, as I said before already, the activity now is so big already in let's say, especially in the UK, and we are, as I said, doing the first big one now in Norway, and Equinor has clear plans for 25 and 26 and 27 and 28 and 29 when they think they're going to start the different platforms, even in Norway. So there can be delays, but really for us it is really about taking the right projects, and it's enough projects to have a robust business for Archer.
Okay, let's go back a bit to well service, which you talked about a bit earlier in our conversation, and you highlighted that this business segment is going really well. But you also highlighted that the international presence of your well service division is quite low. And can you give us a bit on background on that, and how you're planning to change it?
Yeah, that's a good question. Historically, I think Smedvik, we came from Smedvik back in the days. Smedvik is a very known drilling contractor and well services company that was back in Norway. That was the start of what became Seadrill, and then Seawell was spun out of Seadrill and became Archer. So the heritage is in Norway. So this is where the services were developed. This is where the high-end specifications of the oil industry in Norway drove a lot of innovation and a lot of high-end products. So our heritage is here in Norway. Then, of course, we follow some of our key customers internationally with some of our core products that was more easy to sell and maybe didn't require so much footprint. But what we have done in the last few years is to expand really our portfolio. We're much more dedicated focus on growth. Okay, and we wanted to have the growth internationally because we have a large market share for well services in Norway within our segments. And again, we focus on production services, well intervention, while maybe the Schlumberger, Halliburton, and Baker are much more focused on completion and well construction and the new wells. We have this base, so we have developed this. We also bought these companies. So for example, we bought Romar Brado, we bought the coil tubing businesses, and we also transferred wireline units to UK last year. So now we have become a meaningful well service player in the UK. We have about 200 people in the UK now. If you go back 3-4 years, we were probably 30 people. So taking deliberate steps to grow our international presence. So we don't go, we go quite selectively. We have good products, and we just need to grow step by step. And this is what we're doing now. So yes, we can brag about 40 countries. We have operations in 40 countries. But really, it is about how can we get 3, 4, 5 more really meaningful ones. That's the full offering. That is our strategy.
When we talked about the PNA segment, the plug and abandonment, you pointed out that oil price really isn't such a big deal. I mean, these fields need to be decommissioned anyway, right? And how does this stand in terms of well service? How oil price sensitive is this business segment?
Probably 80% of our well services division is related to brownfield and PNA, which is going on at a steady pace and is increasing. So it's probably 20% of our revenue within well services more linked to exploration. Okay, this of course is growing right now, but this is not where we see the big growth. So yes, we are selling plugs. The good thing is, they build, they drill a lot of wells in Guyana. It's a big new area that's been in the last 5 years, ExxonMobil, and we basically sell all our advanced plugs to ExxonMobil in Guyana. So yes, but it's maybe there's a revenue of $7-8 million. It's an example here, in one country, which is kind of more linked to exploration and the prices of the oil. But actually, 80% at least of the well services revenue is really in the brownfield and PNA market. So we are not, it's not going to change our revenue dramatically if oil price goes down, not even the well services. But of course, over time, if it prolongs along low oil price for long, it will hurt us, but not in the short to medium term.
Let's move over to the onshore drilling. And looking at the rig counts, it looks quite promising, the development you've seen the last years. And could you give a bit of background on that and tell us what's going on?
Well, again, the growth in Argentina is really coming in the Vaca Muerta field, which is a shale play similar to the Permian in the US. This is ranked as the probably second or third most prolific shale play in the world. So, they started probably around 2014 to explore in Vaca Muerta and to start drilling. And by now, I think that they have developed very good methods, very efficient. I would say they are probably in many ways more efficient than in the US in drilling these wells and completing these wells. And they got down the cost to a reasonable level. So now it's competitive. Look at lifting cost and these things are now very competitive with the Permian. So there's kind of two remaining hurdles in Argentina to really make this a big export industry for the country. The first one has been how you transport out the oil and gas. So now the investments started actually last year in some transportation pipelines to expand the export capabilities, which is very much not needed. Secondly, there's really been no incentive for the oil companies to export oil and produce for export because it was heavily taxed by the last government. And the new government is trying now to take away all the taxes, or at least majority taxes on oil export. So this is going to, encourage more investments. You can get international prices on the export rather than a heavily discounted price for exporting. You have less incentive to actually drive the production. So, the two things that is going to drive the growth here is really increased transport capacity and the removal of the export taxes for oil.
Good. Let's move a bit on. And so you already mentioned it a bit, but it looks like the new president, Milei, in Argentina, he seems quite pro-business. So maybe we should start hoping that this will give a lift to many businesses in the country. Have you any thoughts?
It's a complicated question, Karsten, and I think the whole business community in Argentina is positive to this change. Okay, I think today also the people of Argentina is hopeful, but in order to fix this and to lift all the vision they have is they are under a lot of restrictions and driving the economy through a recession locally. So they want to stop basically the loss on the state budget that they've had for the last 50 years or so. So it's going to be some challenges in the short term, but really what he's promoting is oil and gas prices in the country has risen by 200% already because the prices have been set free. So they're not subsidizing anymore the country's consumers. So of course, this has a lot to do with then demand, but then now when they're also lifting the restrictions on the export. So this is going to, for our industry, be very good, and long term, very good for the country when they start getting their dollars, the much needed dollars from what they need is to export the grain and oil. That's the hope of Argentina. I think everyone believes that what Milei is trying to do with support of the let's say the right wing in policies in Argentina is the right medicine. The question is sometimes when you take the medicine, it might be a bit painful in the short term, but for our industry, it's going to be very good. So we are very optimistic about it.
Mm. We know that your main owner is also involved in shale on the US side, and what are the differences between onshore drilling in Argentina versus the US?
Well, there's two big areas in Argentina. So I talked about the Vaca Muerta field, okay? Very similar to the Permian. It's the same type of rigs, the same type of fracking services. Everything is more or less the same. You can say that probably there's a little bit less horsepower in Vaca Muerta, per rig, the generators, but it's really the same. It's really the same. It's just they have found the sweet spot a little bit lower horsepower on the generators and stuff, to drill the long horizontals. But very much the same. And then you have the area in the south, the Gulf of San Jose, which is more traditional field, where you drill conventional vertical wells and you operate that way. But there, the big part is just to maintain production with workover services and pulling units. So it's two different areas, but in Vaca Muerta, it's very, very similar to the NORAM business in the Permian business.
How about the cost profile in terms of how expensive is it to extract the oil in the two different basins?
Because it's become quite similar. YPF published and also Vistas published those studies that basically shows the same type of cost per barrel to produce. Our day rates for our rigs in Argentina is higher than they get in Permian, but we also have higher costs. Okay. So it's our day rates, we don't publish them because they're all depending on the rig and the duration of the contract, and we're not so focused on external communication. But you can say, if you extrapolate the latest announcements we had, we have day rates for those rigs in the range between $33,000 and $35,000 per day, which is higher than what you would get if you contract in the Permian right now.
Interesting. And we've also
this is why we have high costs, is because we have unions have dedicated, how many people we need on each rig. So that's a part of this historic socialist country where the unions, together with the government, have decided that we need more people to do it safely. While in the US, we run a rig with less people.
Also, if I'm correct, you also decided recently to invest in 3 new rigs, and what motivated you to do that?
Oh, that's a good question. Who on earth will invest a lot of money in Argentina, Karsten? That's a good question. And to be honest with you, H&P, we rented these 3 rigs from H&P back from 2017 to 2020. So we know these rigs very, very well. They are fitted for the area where we operate in the south, where H&P is not operating. So we could buy them very affordable, I would say, from H&P, which didn't really have a need for it, and it will cost, it's not inexpensive to recertify these rigs and make them ready, okay? You probably have an investment altogether of $9 to $10 million of capex to stand these rigs up. We're going to do that during this year. We paid for the rigs last year, and now this year we're going to stand them up. But we have a payback around 20 months for this investment. So these $10 million have a payback of roughly 20 months. So we are very happy with that. We think that's very good of us. We're adding capacity, we're adding efficiencies for our business, and very attractive terms for us. And it was also a matter of, we had quite a lot of excess pesos in Argentina last year. So that is why what we decided to do was to invest that peso that we couldn't take out. So that's why we invested in a recertification 1 rig already that we spent in 2023, starts working in 2024. This is why we decided to buy these H&P rigs. So there's a lot of good reasons, but in reality, we are a stronger company, better assets, and very short payback. So that's what we thought was the best way to build values for the company, but also for the shareholders.
We've talked to several companies in the industry, and we get the feel of a situation where there's a lot of uncertainty in the oil market, and people prefer the quick and the cheap and the fast barrels of oil, right? And I'm wondering, how is that something that can turn into a tailwind for Archer's onshore production in Argentina?
I think, it certainly helps us. This is good economics in this for the oil companies in Argentina. I think this is clear, and they have a lot of, let's say, local consumptions anyway. So oil industry in Argentina is going to continue and be quite good for us. The question is, can it be exceptional good, and how will Argentina come out of their difficulties as a country and re-enter, the capital market in a proper way? And if they can re-enter the capital markets in Argentina, it will create a lot of value for Archer. It's a substantial uplift in the way I think most investors, they undervalue the assets and the business we have in Argentina. And this is a huge upside, but we have to be patient, be well placed. We have a very good team, working very well with the customers. And today, it's a very self-sustained business unit. When I myself started in the company in 2016, I used to go there nearly once a month. Now I go there once a year because we have a good team, not because I need to fix something. So it's a very good standalone business, healthy business, good people, good safety records, good client relations. So we are very, let's say, optimistic that we can create a lot of value with the right patience here.
Let's move over a bit to the debt side of the company, and we see that you have cut your leverage ratio nearly in half from 22-23. And can you talk about how you achieved that?
So really 3 factors in 23. The first was we did a private placement as part of our refinancing, where we created roughly $100 million of new equity. That helps, of course, substantially. Our growth in EBITDA of 36% helps substantially. But we also generated free cash flow from the business that also helped us delever. So when we did the refinancing in early of 2023, we were talking about leverage ratio about 3.7, and by the end of the year we are at 2.9. So it's quite a strong. We grew better than maybe we had hoped for, and we also generated enough cash flow to really drive down the leverage ratio.
When we look at the outlook for further reductions in 24, it looks more modest. Could you comment a bit on that?
Well, what we model here is really that we are going to grow at a slow pace. We have forecasted 15 to 20% growth in EBITDA, rather than the 35% in 2023. And also we're not planning any private placements. So, but still, reduce the turn from 3 to 2.5 is if you take the big picture, it's a good achievement. And I think if you look at the analyst estimates for 2025, they see Archer leverage in 2025 down to 2 turns, okay? So 2 times EBITDA. And clearly at that point in time, we are very well positioned to maybe get some lower margin on our debt. So we're looking forward to 2025, 2026.
Mm-hmm. Can you shed some light on why the company ended up with a nearly 75% debt level?
I think, historically, Archer had a strategy in 2011 to 2015 to buy a lot of companies and to grow and become a major player, and took up significant debt. So at one point, it was about $1.2 billion of debt. Those acquisitions were not successful. Basically, there's not much remaining from those acquisitions today. So when I came into the company in 2016, we had $800 million of debt and EBITDA of 50 in 2016. And today we have then gradually increased, improved our leverage ratio, where we now have a net debt of, depending on the quarter, but around $370 million. And we have a leverage ratio 2.9. So historic acquisitions was really drove up the debt level in the company, and together with the board and the owners, and really driven down the leverage ratio step by step. And I think now we are really starting to see great opportunity that we also turn around the business to a very growing business. So we have excited owners.
The market seems concerned that your debt level is high and that the interest is high at between 11 and 12%. Can you give an update here in terms of your debt serving, and are you better able to service debt now as the business is improving?
Definitely. So when we refinanced, it was quite a challenging capital market, I would say. It was at a time where the interest rates in the world was growing or increasing dramatically. And we came out when we were refinancing, with a target leverage ratio of 3.7. So you can say that is sort of the price we had to pay when we refinanced. So you can say it's expensive, but at the same time, we also have quite a bit flexibility. So far is still quite high, in the world, but it's predicted to come down towards the 3% in 25, 26. And also, if you look at our average cash margin, on our loan is 4.4%. And if you only look at the cash margin, actually, we don't have high liability, but with the peak interest, we have a average margin of 6.9. So that is sort of the structure we have. And we also have an opportunity to pick the whole second lien if you want to. So if you're growing a lot, or if we get into trouble or the economy, in the world collapses, we still have a lot of flexibility in our cash cost for our interest expenses, if you follow me. So there's a trade-off here with flexibility we have, the timing when we did it. I think, as I just mentioned for you, our margin, when we come down to 2 times leverage in 25, 26, the margin will be significantly less than what we have today, and will set us up for, we think, quite a big improvement in our margin level. So that's our strategy. Grow the EBITDA and delever, so we can create flexibility and the value creation for shareholders.
Is there a risk of new private placements?
We have no plans today to raise any new equity as we stand today. However, I also want to say that we have big growth ambitions. We are still looking at inorganic growth. So if you can find an opportunity to increase shareholder value in connection with a large M&A transaction, I will not rule out that will be considered, but it will not be the need for refinancing that should drive our private placement today. It's not on the right.
I guess we already touched a bit upon it, but I see that analysts have became more positive to the acquisitions you did from 2019. And what's been the difference? What have you been doing differently in more recent years?
I think 2, 3, 4 things, Carsten. We focused on smaller transactions. We focused on transaction that was very accretive to us and had synergies. So we bought companies 2 to 3 times EBITDA, so highly leveraged, deleveraging, but also enhance our position. We had some acquisitions we did. I can mention one, not by name, but one where we spent $1 billion to acquire the company, and that acquisition gave us $6 million less tax cost in the next 3 years. So me not having to do a fantastic business, I spent $1 million to get a deduction equal to reduced tax payments, not tax payments of $6 million. So we have done a few of these technology, but also trying to optimize the cash flow going forward, and been very selective in doing it. I think now they see that we have demonstrated we can integrate, we can grow them, and we're creating kind of a track record of doing it. So that's been very helpful for us, and I think we have been diligent and smart about how we're going about it, I think.
Critics of your company have pointed out that Archer is not a stock you should buy before you see company improvement. And do your latest financial updates demonstrate such improvement?
We think certainly so, and we see a renewed interest from more investors. I think some investors have had the view that you play out, Carsten, here. I think the 35% growth in 23 and additional 15 to 20 growth this year is really starting to pay off. So I think the growth is clearly a catalyst for value creation here. So and at the same time we are deleveraging. We have quite limited downside because we are in this brownfield market and we are in the PNA market. So we're not so dependent on oil price in 3 years' time will be terrible and all the drilling will stop or seismic will stop, or we will keep going on just like we did in 2020. We had the good cash flow generation also in 2020 as a COVID-19. So we are a very different company than the other, let's say, traditional oil service companies. So that gives us very limited downside as well, And if you look at the multiples now, it's very well below what it historically has been. Of course, it's nice to refer to what it used to be in the good old days, but even in the last 3-4 years, it's been around 6 times earnings. And right now we are trading on less than 4 times 2024 earnings. And you can see that also from the analysts that has, all of them have very strong buy, and they think the stock is undervalued as well. So I think we just have to keep delivering our growth, and I think our investors will come back and really start to appreciate the mismatch in valuation in the Archer share.
Yeah, so when I look at your valuation, it looks like you had an EBITDA 2023 of $160 million. Your market cap is about $142 million, and enterprise value at about $533 million. So if multiples were at historical averages, what pricing would we be talking about?
Well, it's always historic pricing, and it's but if you say the multiples from 2020 to 22, take the recent history, has been around 6. Okay, that means that if we were trading at 6, the share price should be 2.4 kroner per share. So an increase from today for about 150%. If we trade at historic, in the last 3 years, historic trading multiples. So I think we became a bit unfavored during the refinancing, where we had to refinancing a lot of debt, and we had I don't think the market really appreciates that we had $360 million of debt with hedge funds, international hedge funds, and also it can be quite difficult in refinancing when they have the power in the consortiums and refinancing, and that sort of forced the pricing of the equity as well in a way that was brutal for existing shareholders, me including, and the main owners as well, I can say that. At the same time, 77% of all the new cash that came from existing shareholders. So, unfortunately for those people who could not follow on to the investment, didn't have liquidity to do it, but you had a chance to keep your ownership and the value par with the others. So let's see how it plays out this year or next year, but I think the analysts are clear in their recommendation, and we believe there is a good upside in this with this growth we are seeing today.
Dag Skindlo, CEO of Archer, it was a pleasure to sit down with you today and discuss your company.
Great, and thank you. And for all you out there, if you have further questions, don't hesitate to reach out to IR or myself, and we will try to educate you on Archer and the transformation we're going through for the time being. Thank you.